welcome everybody. Welcome to the Texas REIAs, the largest by far network of real estate investor associations in the great state of Texas, with over 100,000 members, participants, and attendees. We got started in 2003, so we've been helping Texans invest in Texas for 20 years plus. There's a lot of people in this vast network. There's a lot of resources. We provide all kinds of resources to the members. My name's Phil Grove. I'm one of the co-founders of the Texas REIAs, but the Texas REIAs provides a network, provides money. There's over 1,000 private money lenders in this network, training, market data, power teams, resources, basically everything you'd ever need to invest in real estate. And we're going to start tonight's presentation with a market update. And we're going to talk about what's going on in the real estate market. That's the intro topic for tonight. So what would you say is the big story in real estate? What's the story over the last year in real estate? What happened? Interest rates changed, didn't they? Yeah, they changed. What happened to interest rates? Did they go up or down? They went up. So interest rates went up. So what do you think, guys? Interest rates, are they high or are they low? What do you think? Who thinks interest rates are high? Raise your hand if you think interest rates are high. Who thinks interest rates are low? Raise your hand if your interest rates are low. Look at that. You know, isn't that interesting? We have a mix. Compared to what is exactly the right answer. So I got to tell you, 1981, interest rates on mortgages were 18%. So for all of you that are complaining about 7% or 7.5%, yeah, they're low compared to 18%. Now they're high. I'm pretty sure the people who think interest rates are high have really been paying attention for the last 2 or 3 years, right? And if you've been paying attention for just the last few years, you're like, oh my gosh, interest rates are high because they used to be like 3 or 4 and now they're 7, right? And so relatively speaking, they're high. My perspective, I'm doing this 20 years, that interest rates are normal. That's what I describe this as. This is normal. Look, I started investing in 2003. I have a lot of rental properties all the way back to 2003. Most of my rental properties had their original mortgages that were 6.5%, 7%. Some are even 7.5%. That was normal. This is normal again, right? 3, 4% mortgages, that's not normal. Okay, when did that happen before? Other than just the last few years, when did we before that have 3 and 4% interest rates? That was never. It's never happened before, right? It never has happened before. 100 years never happened before. My guess, and I have no idea, but my guess is you'll never see that again for the rest of your life, for your children's life, for your children's children's life. So if you're waiting around, and the world that would have to happen to get you 3% mortgages again, you don't want to live in that world. I mean, that's a pretty terrifying series of events would have to happen to make that happen again. Now, could it happen again? I don't know. I mean, nobody can really tell the future. But I would say, I don't expect that to ever happen again in my lifetime, my kid's lifetime, or my kid's kid's lifetime. I mean, it was not normal. It was abnormally abnormal. It was freakishly abnormal. So I would describe this market as normal. Now, I will say I like normal personally. I like normal. And the reason I like normal is because it's just more predictable. You know, I do commercial, I do residential. So let me tell you what happened with commercial real estate a few years ago. People were doing these deals. It was very competitive, especially in certain segments, asset classes like apartment buildings. So people were buying them for, frankly, top dollar, and they were financing them, you know, with the top dollar offer, and they were financing them with these 3% mortgages. And the numbers worked, all the numbers worked. But you know, commercial deals, these loans are not 30-year loans. Commercial loans are typically like 5-year loans, 8-year loans, 6-year loans. I mean, they're short-term loans. Commercial deals constantly turn over. They're constantly selling, buying, refinancing, et cetera. So all these properties, right, where they paid top dollar and it only worked because they got 3% mortgages, now all the loans are coming due. And you can't get 3% mortgages because it's back to normal. So back in this normal world, the deals don't work anymore. And now they're having to do cash calls. What does that mean? They're having to put more money into the deal to keep it doing. Because, if you can't get the money to work, if the property doesn't generate enough income at 7 or whatever percent interest, you're going to have to buy the loan down. You're going to have to borrow less, to have a smaller loan, right? Because you're going to have to put more cash in to make the deal work, right? To make the deal solvent. So a lot of abnormal things happened. And abnormal things cause some deals to go south, right? Now, I like normal deals. Unlike commercial deals, the question you should ask is the same question Wayne Gretzky would always ask. He would always say, don't skate to where the puck is, skate to where the puck is going, right? And you got to ask in commercial deals, where's the puck going 5 years from now? Because 5 years from now, that's your exit strategy. That's when you're going to sell or refinance or do whatever, right? If I were investing 3 or 4 years ago, would I bet we'd still have 3 or 4% mortgages in 3 or 4 or 5 years? I'd say no way, because that was abnormal. Would I bet that 5 years from now we're going to have 7% mortgages? I would bet yes, probably so, because that's normal. And maybe we'll even get better than normal. I don't know, right? We really don't know. But yeah, interest rates have changed. And then depending on your perspective, that's a good thing or a bad thing or a high or low or whatever. And that's perspective, right? I was fascinated when I say who thinks interest rates are low. We had a lot of hands going up, and I'm guessing those were hands of people that have either been in the market or been paying attention to the market for a long time, right? So they had a different perspective than the hands that went up for the people that had only been kind of paying attention or in the market for a short amount of time. So interest rates have changed. Certainly that's true. And they've gone up compared to where they were a couple of years ago. That's certainly true. And when interest rates go up, what happens to home prices? Who thinks when interest rates go up, home prices go down? Okay? Who thinks interest rates go up, home prices go up? Okay, we got a little of this. And most of you are not voting because you're afraid to say something wrong. Yeah. So what does interest rates do to home prices? I'll tell you what it does. It does this. Okay? It pushes up and down at the same time. There's things that are pushing up and there's things that are pushing down. Okay? So I don't know if I have the chart in here. I had a chart going back to 19. Oh, here it is. Let me show you this chart. This is a chart of interest rates versus median home prices. Blue is interest rates. Starting in 1975, from 1975 to 1981, interest rates got all the way up to 18% for a mortgage. And when interest rates went up, what happened to home prices? They actually went up. And when interest rates came down, what happened to home prices? They actually went up. And interest rates went up and down, up and down, up and down. What happened to home prices? They, for the most part, went up. Now, there were some bubbles in here, right? 2008, 9, 10, right? There were some bubbles in here. But for the most part, there's not much correlation. Now, why is that? Because it pushes up and it pushes down at the same time. Okay, why are interest rates higher? Because we had something happen. What happened? We had this thing called inflation. You guys heard of that, inflation. Now, when I hear people talk about inflation, like the press talks about inflation, they always talk about it in negative terms, like inflation bad, inflation bad. I disagree. Personally, I love inflation, but I have a different word for it. I call it appreciation. Yeah, same thing, guys. And by the way, when all your wealth, like my wealth, is all in real estate, then you go to bed at night hoping for more inflation, i.e. appreciation. My portfolio went up more than 30% in just a couple of years. Awesome, right? Now because of all that inflation, i.e. appreciation. So that's pushed prices up. Now as a result, right, and we raised interest rates, making mortgages less affordable, so less people can afford mortgages, so there's less demand, right, and that pushes prices down. But the tie between interest rates and home prices, real estate, it's not interest rate, it's supply and demand. And that's what real estate cares about. It cares about supply and demand, purest market in the world, right? And you have to look at what's going on and how it affects the supply and the demand. Like, money in 2008, 2002, 3, 4, 5, 6, 7, right? What did we have? We had subprime lending. Remember that? Subprime lending. in order to get a loan, right, back in 2005, you had to walk into a bank and you had to say, I would like a loan. A banker, they'd walk up, they'd hold a mirror under your nose. If you could fog the mirror, you got a loan. That was the lending process back in 2005. And by 2007, all of the banks went bankrupt. Remember that? Yeah. Total economic abyss. So at any rate, 2002, 3, 4, 5, 6, 7, right? Money was easy. Anybody could get money. You didn't have to have job, credit, income, nothing. Anybody could borrow money. And because of that, builders were building houses as far as the eye could see in every direction. You're building bazillions of houses where just money was easy and practically just anybody could get it, right? And to sell all of those bazillions of houses, anybody could get a loan. So you walk into a bank, you fog a mirror, you get a loan, subprime lending. Everybody got a loan. Everybody got a loan. So everybody got a loan, and everybody built a home. Everything was okay for a couple of years there, but then, surprise, surprise, it turns out it's really stupid to give people that don't have jobs or credit or income loans, right? So that didn't work. And in 2008, the banks all went bankrupt. Did you know that? Yeah. You know the government actually changed the definition of bankruptcy in 2008? All that mark-to-market stuff that was about tinkering with what's technically bank, but they were, by any real reasonable definition, they were bankrupt. But they were too big to go bankrupt, to fail, so we bailed them out. But lending just stopped. It didn't slow down. It was like a train hitting a wall. It just stopped. So when lending just stopped, right, you had all those bazillions of homes, and people could no longer get loans, right? So now you had incredible amounts of supply and no more demand. And crash and burn, right? The market just fell off a cliff. The market crashed. It crashed. Now, eventually the banks got bailed out, and eventually they got back into the lending business. But all of these years later, today, what do you have to do to get a loan? Turn over your firstborn, fill in a 1,900-page application, submit blood samples. A lot. You have to do a lot. Money got cheap, but it never got easy. It never got easy. And because it never got easy, right, there's been a constraint on lending. And because there's been a constraint on lending, we actually have a housing shortage. Did you know that? Who's heard that we're in the middle of a housing shortage? Yeah, some of you are aware of that. We have 6 million fewer houses than we need for the amount of people that need someplace to live, right? We have a constrained supply, right? And when you don't have enough supply to satisfy the demand, what does that do? That pushes prices up. So that's another up push on prices. But interest rates went up, right? So loans are less affordable, so there's less demand because fewer people can afford. So we got things pushing up and we got things pushing down, okay, on this market. And when you throw it all into a blender and you spit it out, what do you get? And the answer is the market is flat. The market is flat. And what happened, and I'll show you the last 3 years, and we'll dig into the different cities. But in 2021, the market was on fire. 2022, the market was still pretty darn hot. And then in 2023, it just flattened out. So it went up, and then it just went flat. Flat as Texas flat. It just went flat. Now, I will say something is starting to change, right? About a quarter ago, after being flat for a year, about 1 quarter ago, things started to tick up again. So it looks like, and we'll give you a forecast a little bit later, but it looks like the market's bottomed and it's starting to come up again. And each of the cities is a little bit different, so we'll dig into the different cities. But if you take a look at the data, 2022 versus 2023, flat as a pancake, flat for all of Texas. Prices didn't change. Now the volume changed. Fewer buyers and fewer sellers. We'll talk about that. So there's fewer people selling, fewer people buying, but price is flat. Now each city's a little different, and we'll go into the different cities. Now this is year over year, and we just noticed just over the last quarter, this is the latest data, the prices are ticking up a little bit. We're up about 3.5%. And the volume is kicking up a little bit. So something started happening over this last quarter that we haven't seen in about a year. And by the way, one other little data point to share with you. This data is presented by the Texas REIAs. Most of this came from the Texas A&M School of Real Estate, which has some of the best data on Texas real estate available. We do not have an agenda here. We're not trying to sell you something. We're not trying to persuade you of a particular idea. Like if you asked the National Board of Realtors, they give forecasts every quarter, and every quarter for the last 100 years, the forecast has said that real estate prices are going to do what? They're going to go up. They always say it's going to go up because they want everybody to think it's a great market no matter where you are in the market, right? And that's their agenda. Nothing wrong with that. I'm not going to complain about that. But we have strategies for up markets and down markets and sideways markets and every other thing. So I'm going to just tell you the data. We'll give you a forecast, but I'm going to express that I'm not trying to persuade you that the market's going to go up or down or sideways. So you can make your own decision, and I'll give you strategies to handle any of those scenarios because you can make money. Sometimes it's easy to buy and hard to sell. Sometimes it's easy to sell and hard to buy. It's never easy to buy and easy to sell, right? You know, each market brings its own opportunities with it. But let's dig into some more of the data. Texas, if you look at Texas, the average price house in Texas, $404,000, up a little bit, 3.5%. And the median price is actually up a little bit as well. The median price home is $334,000, up 3%. Now, this is the data point I think, in my opinion, is the most important data point on the chart. Months of inventory. This is a really important number, months of inventory. What does that mean? There's a couple of ways to think about months of inventory. The easiest way to think about months of inventory is if you just took all the houses that are for sale in the MLS and you stopped adding any new houses. So we're not going to add any more. We're just going to take what we got that's on the shelf for sale and we're going to just keep selling it until it's gone. How long would it last? And the answer is 3.6 months. So we have 3.6 months of inventory. That's how much inventory we have. Now to put that into perspective, let's put it into perspective. They say if there's less than 6 months of inventory, you have a seller's market. If there's more than 6 months of inventory, you have a buyer's market. If there's right around 6 months of inventory, you'd have a neutral market. That would be a normal market. We have 3.6 months of inventory. That is a pretty strong seller's market. So if you're wondering, like, how's the market? Well, by any historical, sample point, that's a pretty strong seller's market. Now, it's not as strong as it was. A year ago, there was 2.6 months of inventory. You had an on fire market. So compared to on fire, go back to perspective. Interest rates high, low, market good, market bad. Market's good by historical standards, but it's not as good certainly as it was a year ago. So things have changed. The active listings is up. When the inventory goes up, that means there's more listings for sale. Closed sales up, so the market started to pick up. It had been going down, 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 flat, flat, flat. Now it's up, up, up. And to go back over the last 3 years and kind of look what happened, in 2021, the average price house in Texas went up 18% in 1 year. 2022 went up another 10.7% in 1 year. And then 2023, flat. So it went up, and then went up some more, and then it flattened out. And it just stayed flat for 2023. And over the last quarter, it's starting to get a little bit of a uptick. If you look at some of the different cities, each city is a little different. Houston, the second most affordable city in Texas, average price house in Houston, $400,000, right at $400,000, up 4%. Median price $330,000, up 3%. That was flat and down just a quarter ago, and something's changed a little bit. Houston looks a lot like Texas. 3.4 months of inventory last year is 2.5. And the numbers on the bottom look a lot the same, right? 2021 up 16%, 2022 up another 10%, 2023 flat as a pancake, as is Houston is flat. Okay, let's take a look at the big D, Dallas. The average price house in Dallas is $495,000. So yeah, second most expensive city in Texas. Median price, $394, also up 2%. Months of inventory, pretty good. Just 3 months of inventory, which is less than it is on the state. Not as good as it was a year ago. A year ago it was on fire, 2 months of inventory. Now we have 3 months of inventory. Now, I will say something interesting about Dallas, and I don't know why this is the case, but Dallas has always been the bellwether of Texas. I don't know why, but if you kind of want to get an idea what to expect next, look at Dallas. It always leads the state in terms of like when the market starts to go up, when the market starts to go down, when the market starts to level out. It always is like several months ahead. I don't know why. There's other things we look at, like inventory gives you a snapshot of the future. Condominiums. We always say condominiums are the canary in the coal mine, right? Condominiums are the first thing to go down. They're the last thing to come back. So like if the condo market is hot, you can sell a condo, you can sell anything, right? And that's why it's called the canary in the coal mine. So the first thing you're going to see is condominium inventory. When the condominium inventory starts to go up, housing is following, right? Dallas, for some reason, has always been the bellwether of Texas. I have no idea why, but Dallas started to heat up about a quarter ago. And if you look back over the last 3 years in Dallas, in 2021, Dallas shot up 20% in 1 year. 2022 has shot up another 15%, and then 2023 flattened out to just 1%, which is flat. Now the volume went down a little bit, but the price is basically flat. Little things going on the lease side. Leases are up a little bit, about 11%. Lease prices up about 2%. This has to do with how many more apartment buildings have come online. There have been new apartment buildings coming online. Has to do with if people can't afford to buy a house because interest rates are a little higher, more of them have to rent because everybody has to live somewhere. So that affects the multifamily lease space a little bit. Okay, so that is Dallas. And pending sales are actually up a little bit. So something has turned around in terms of Dallas. Closed sales flat. It had been down. Now it's flat. Pending sales up. Listings are up a little bit, but that's because the inventory is up. Okay, Austin. Let's take a look at Austin. Now, Austin, I will tell you, is an outlier. And there's a reason for it. I'm going to explain why Austin is an outlier. But the average price house in Austin is $553,000. That is not a typo. Up 1% year over year. Median price $440,000. Up 1% year over year. You know, and that's an average price house in Austin, right? Almost $600,000, $553,000. You know, we did a little research to try to figure this out, and it turns out that Austin is actually Latin for San Francisco. Yeah. You know, Elon Musk moved to Austin, and then Apple started to move in, and Amazon, and then Meta came in, and everybody's setting up these high-tech jobs, and they brought all these six-figure high-tech guys with them. And, you know, things started to change over the last several years in Austin. And the big story in Austin was 2021. So what happened in 2021? In 2021, prices of houses in Austin went up 29% in 1 year. And I was there. And I got to tell you, here's what happened in 2021 in Austin, Texas. In 2021, there was not 3 months of inventory, 2 months of inventory. There was 0.4 months of inventory. That's less than 2 weeks of inventory. So what happened in 2021? Somebody would put a house on the market. They'd get 11 offers in a weekend, just like that. One of them won, 10 of them lost. So the 10 people that didn't get the house they wanted made an offer on a second property. They got 11 offers in a weekend. One of them won, and 10 of them lost. And after people were losing over and over and over again, they got furious. And they started screaming at the realtor, I need to move here. What do you got to do to buy a house here? And the answer was this. It was normal in 2021 in Austin, Texas, to buy a house 5 to 10% above appraised value. It was that crazy. Now, by the way, what do you have to do to buy a house above appraised value? Because the bank will not allow you to buy a house above appraised value. You have to bring your down payment and then the bank money, and then you have to bring money because the bank will only finance a property up to the appraised value, not more. So you have to bring extra money on top of the down payment and the bank money to finance the difference, to pay cash down the difference between what is worth the appraised value and what you're buying it for. So it was normal in 2021 in Austin, Texas. Never saw it before. I don't know if we'll ever see it again, but it was normal in 2021 for people to buy houses for 5 to up to 10% above appraised value. That was a freakishly abnormal situation. In 2022, it didn't get much better. Prices went up another 10.4%, and then in 2023, prices came down 8%, and then they flattened out. So, perspective. If you went to Dallas, prices went up 30%, and they flattened out. If you went to Austin, they went up 40%, came down 10%, and they flattened out. So if you owned a house for 3 years in Dallas or Austin, you made exactly the same amount of money. If you owned a house in 1 year in Austin, you lost some money, and that's just perspective. But that was the outlier. That was Austin. Where are we now? 3.2 months of inventory. Pretty good. This has been creeping down. Not as hot as it was a year ago, 2.6, but it's pretty good. Active listings up, but not a whole lot, just up a little bit. Pending sales is actually up a little bit, and closed sales is up a little bit. So the market definitely flattened out, and the market seems to be on a slightly upward trajectory. San Antonio, the most affordable market, major market in Texas. Average price house in San Antonio is $349, down 3%. Median price down 3% as well. Pretty flat, down a little bit. Months of inventory in San Antonio is 4.3. San Antonio, I don't know how to describe it best. It's the poorest major market in Texas. I guess maybe you'd say that. It doesn't have the high tech and some of the higher paid jobs that some of the other major cities has. But it's been pretty good. 2021 up 16%, 2022 up another 12%, and then 2023 basically flat, technically down 2%. So that's the market in Texas.